Hello, and welcome to another session on Reflections on Investing by the Cornell Capital Group. Suppose the Redditors suddenly decide to buy a lot more stock. What happens to market prices? That's called the elasticity of the market, and it plays a critical role in understanding what moves stock prices. And recently, two professors from the University of Chicago and Harvard have taken a new tack on the question. But let me start with the traditional view. If you look back to one of our first reflections on investing, we talked about the fundamental valuation rule. And that said that the value of stocks was the present value of the cash flows that they provided. And if that's true, suppose the Redditors now want to buy more stock. If they start to bid the price up a little bit so that it exceeds the present value of cash flows, the traditional theory says that sophisticated investors, institutions, and so forth would sell the stock. So the overall price would not have to move up much to meet the demand by the new buyers. And that traditional theory says that the market is elastic, is the term that economists use. Well, in their new paper, the professors take a very different view. They say the traditional view really is not practical. In fact, institutions have goals for how much stock they want to hold, and they don't change them very much. So when the Redditors want to buy more shares, hold more stock, there are no new shares to be held. Remember our last reflections on investing. We talked about the number of shares available is largely fixed. I say largely because with stock prices at this level, companies are trying to issue shares at a record pace. And that certainly makes good sense. If I were the CEO of GameStop, I'd be selling every share I could. But even so, the number of new shares that companies are selling are tiny compared to the total amount outstanding. So when the Redditors want to buy, there aren't new shares available. Well, then how can they hold more stock? Well, what they can hold is a greater dollar value of stock. So their actions, they come into the market, they bid up prices, prices rise, the overall market capitalization rises, and eventually it rises enough that there's a big enough dollar amount of stock available so that everyone's happy. But that scenario, as described by the two professors, implies a very inelastic market. In response to the new demand, prices have to rise a lot. In fact, the professors estimate that if the Redditors want to hold $1 more of stock, to satisfy everybody, stock prices have to rise by $5, so that the market is very inelastic. And this can explain why stock prices seem to move so much in response to changes in supply and demand. And if it's true, it's one explanation for why stock prices have risen so much on very little fundamental news in the last 3 or 4 months. But the inelasticity works both ways. If the Redditors now want to sell, stock prices have to fall by $5 for every net dollar they want to sell. At this point, the two competing theories there's no clear view in which one's right, and maybe the truth is somewhere in the middle. But if the market is a good deal more inelastic than we have previously thought, it has strong implications for how much stock prices might move if there's a change in demand. This has been Reflections on Investing by the Cornell Capital Group. Thank you.